Hello, everyone, and welcome to another Wall Street from Main Street podcast. Joining me today will be a returning guest, Sean Hyman from the Ultimate Wealth Report. Sean, thanks for coming back.
Hey, good to be here.
All right. The first topic I wanted to get into today was what's been on a lot of people's mind is the oil price crash. Today it's roughly around $50, but it's gone down from $96 a barrel to $50. What are your thoughts on why it declined so much in such a short time?
Yeah, I mean, the decline is from an abundance of, it's just basically an oversupply issue. Saudi Arabia is just cranking out oil like crazy. Our shale oil drillers are doing the same. And between the two of them, especially with the added amounts of oil that we put on the market through the abundance of shale oil drilling, it really just put a glut of oil on the market more than we could use, and it drove the price down. And then, of course, now you've got Saudi Arabia really trying to perpetuate that, keeping their production very high, and trying to play a game of retention of market share and possibly even gaining market share as they keep their oil production high, in hopes that we have to drop ours here in the U.S., which we are doing. We are idling quite a few oil rigs here. And, of course, their hopes are that, this is my opinion anyway, their hopes are that they run some of these shale oil drillers out of the business and cause some of them to go under and bankrupt, and that way they retain and regain more market share when oil does recover.
Yeah, I've definitely seen a lot of idling rigs. In fact, that seems to, in my opinion, put a floor in the price for now. It's been idling at the fastest rate in roughly 2 to 3 years. I personally don't think shale oil at these prices are sustainable. What do you think about shale oil at this price? Do you think we'll see bankruptcies in the future or no?
Well, at this point, I think we could probably see some bankruptcies of some smaller shale drillers, possibly ones that basically counted on $80 to $100 a barrel oil, and so they were increasing their debt load in light of that being the case, and then it drops to 40s and 50s, and then that's when they have their uh-oh moment. And so I think that possibly could get the best of some of the smaller guys, some of the bigger guys that probably is not going to take out. So at this point, I don't see it having a material effect unless it is prolonged. A year from now, if we're still at $50 a barrel or $45, then there's probably going to be a lot bigger issue. If this lasts for just like some more months, then it's probably not going to be that big of an issue.
Yeah. Actually, I did want to correct myself. We actually have seen one bankruptcy. It's small and minuscule, but I meant on a larger scale. So, and one thing about the oil I actually wanted to ask you is a lot of people make a big deal out of the storage at the Bakken where it's 75% filled up. Now, do you think that's more of a demand issue, or is it more of a logistics, more so like they haven't approved Keystone, so it's harder to get to market, so storage is building up?
Well, it probably is harder to get to market, and Obama's probably going to veto Keystone, so that'll probably further delay that all the more. But Keystone would be perfect for Bakken and would get oil out of there even quicker. It would get it out of there safer, and it would get it out of there cheaper. So it really is the answer. But, of course, his buddy Warren Buffett, ships oil by rail. And even though it's supposedly 10 times more dangerous to ship it that way, he's still got an inside scoop with Obama because, remember, he used to be on his financial committee, basically. And so I think he's doing Buffett a lot of favors and holding off the Keystone. And so, I would hope that we would get the Keystone well before Obama's out of office, because even then it's going to take like a year or two to build. So you're not going to get this thing to pop up instantly, so it'll take time. And, gas and oil prices are low now, but we've got to think about our future. And if we don't get something like that built, then we could be looking at, well over $100 a barrel oil again, in the not-so-distant future.
Yeah, you brought up a good point, and Warren Buffett was one of his biggest contributors. And if you look at Buffett's investment portfolio, he took that Burlington Railroad, he took that private. So he has a big stake, for those who do not know, in the Keystone not being built. And he owns Suncor, and he also owns the refinery. So he has a big stake in that logistics.
Yep, absolutely.
So one last question I would say about the oil sector is, in terms of investing right now, are you investing right now? Is this a good time, do you think, to buy oil, or are you waiting? What are your instincts right now?
Well, I mean, I think it's a good time to buy oil stocks, for instance, because a lot of times oil companies will start to rise a little before the bottom of oil itself. Also, a lot of these oil companies have been so beaten down that they've got great dividend yields now. So if you go with some of the big, deep-pocketed guys that have been around forever and are probably going to be around forever and have big, overly sized dividends, then you're probably going to do well. So more specifically, ones like BP, Total, symbol TOT, some of those guys I think will do well. ENI, symbol E. Those are the places that I would be, because they're high dividend yielders that are literally earning like 5-6% dividend yields. So even if oil traded water for a year, let's say, you're still earning 5 or 6% on your money while you're waiting. And then when oil takes off, these stocks take off, and you're going to get the high yield plus the appreciation. So to me, those are some plays to where I believe that you'll end up beating the market over the next 24 months just by being in those.
Yeah. Well, you actually brought up a good point with, I would say, ENI and Total. Those are international companies. And, one of the weird things, or not weird, but one of the pet peeves of international oil companies is they're actually more yield-friendly than American counterparts. My question about BP is, we had Dr. Kent Moores on Thursday. He said it's an inefficient company. Does that worry you at all, or?
For which one?
BP.
Oh no, yeah, I saw one article on it that says BP was going to be bankrupt within, I don't know, a certain length of time or whatever, and I thought that was just crazy, because I mean you can simply just look at the balance sheets of these companies and somebody judge for themselves, so it doesn't even have to be a matter of opinion. So with BP having over $30 billion on its balance sheet, and it's got $52 billion in debt, but again, it's a $125 billion company. So again, that's low debt relative to its size. It's well capitalized. Even in a tough year last year, they made over $28 billion. So to me, like, these are the types of companies that I want to own, is the ones that people are misjudging, the ones that they are basically miscalculating, and the sentiment is so bad for. But yet when you turn to the balance sheets, you don't see the same story as what people are saying out there. So those misalignments cause a lot of value to be had in the stock for people who will recognize that, seize it at those value levels, and then that'll be patient and be willing to hold it a year or two or so. And BP, as I'm looking at it right now, yields 5.7% on its dividend. So as long as that stays, then they've got a heck of a dividend yield that's more than over double what you would get out of your average S&P 500 stock.
And one other thing about BP is that there's a rumor that Exxon is going to buy them out. Do you think that's feasible at all, or even possible?
I don't think it's feasible at all. I don't necessarily think it's possible. They're just such a huge company. I mean, it would be. Normally these guys will go after smaller companies than BP to acquire. I guess if anybody could have the clout and the ability to, it would be an Exxon Mobile of the world for sure. But I don't necessarily see that happening. However, if it did happen, of course, usually if you're going to get bought out, you're going to get bought out at a premium, and so it would be an instant kicker for the the return of those that held BP.
And well, one other thing, actually, I was just thinking of this as we were talking about Exxon, is, would you say Exxon might be a good barrier of judgment of when to get into the energy market, just based on their past history. In 2000, they bought Mobil and then became Exxon Mobile. In '08, they bought XTO, even though that's a natural gas company, not an oil company. But they seem to get in on bottoms for buying large companies.
Yeah, they definitely are very smart. They're very savvy. I mean, they didn't get as big as they are by not being, so they got very competent management and very competent advisors. So, I would pay attention to anything like that as well, because I think those could be good signs. A lot of times I'll avoid ExxonMobil as a stock, just buying it just because it's one of the first ones that's run up, and it usually won't be as good of a value, and it usually won't have as good of a dividend yield. So I'll go into some other stocks that I favor over it as buying it as a stock. But as a company, I think it is smart to watch their acquisitions and what they're saying about the industry.
Mm-hmm. All right, and I actually wanted to bring up an article you wrote about now's not the time to buy a gas guzzler, and it talked about emotions in herds. Would you be willing to talk about that a little bit, about why you shouldn't buy a gas guzzler and why emotions are just can ruin an investor?
Yeah, absolutely. Right now, I mean, people see gas at, $2 or so a gallon, and they remember, the days of $4 per gallon when they were all freaking out, and they say, wow, gas is so cheap, and they feel like it's going to be this way forever. So, as a result, they think, well, now, I mean, it doesn't matter if there's a big tank on an SUV, I can more than afford to fill it up. But the problem is that what they don't realize is the low gas prices are not a permanent situation; they're a temporal situation. And most people are going to buy their SUVs on a loan that'll be 3 to 6 years in duration, and the chances of oil being back to $80, $100 a barrel or more over that 3 to 6 year period is enormous. And so, the likelihood of just a couple of years out, them being stuck with a high SUV payment and a high fuel price is very likely. And so, if anything, now is probably the best time to sell your SUV. I've got a Lincoln Navigator, and who knows, we may throw this a bit soon, because everybody and their mama right now wants an SUV because gas prices are so cheap.
Yeah, and in terms of being a contrarian, buying a hybrid right now actually is a good contrarian. At least from what I read of cars, a lot of dealers can't even give hybrids away now. And that's the sad thing, is a lot of people think they're permanent. Meanwhile, if you look at a lot of these companies, they can't produce at a profit. And then not only that, OPEC. Saudi Arabia is running its biggest deficit. They'll need roughly $94 oil. Venezuela is on the verge of collapse now. I don't think it's solely low oil prices. I think it's just more the straw that broke the camel's back. I think it's Chavez and the socialism, but Iran can't afford it. Russia needs 94. So buying a hybrid right now would be prudent, and the gas guzzler, it's definitely not long-term thinking, in my opinion.
Yeah, exactly. With these guys, I mean, because a lot of people go, well, how do you know oil's going to rise? And those are the reasons that you just mentioned, is that these guys have to meet their budgets. They have to, and if anything, these guys are going to have larger budgets going into the future, not less. And because they've got to provide a certain amount of level of benefits and things like that to their people these days, because they remember the days of the riots where they're practically starving off their people and things of that sort. And so these dictators want to stay in power, and so they've got to fuel the budgets that will cause them to remain in power. And so because I believe that they want to stay in power so bad, and because they need $90 to $100 a barrel oil or more to meet those budgets, I know that oil will go back up to those levels, and gasoline will go back up correspondingly.
Mm-hmm. All right, now I want to switch topics, because I know you do a lot in gold market, and you're I would guess a gold bull. right now, it started off as a January rise, and it seems like every year from 2013, 2014, we get a bounce in January, and then it's corrected or has gone down for the month of February. Where do you see gold heading right now?
I think, now, in the next day or two, week or so, I mean, it's hard to gauge, but over the coming weeks to months, I believe we'll see gold see its next surge higher. Gold had come from under 1140 to above 1300 in a relatively short amount of time. And so, it's a natural course for it to correct part of that quick gain by consolidating that and having a pullback within that. And that's the next phase of what we've seen over the last, few weeks or so, from 1300 down to the, just shy of 1200. And so I think that the next push will be notably higher, and we'll push it past 1300. One thing that could help fuel that is the U.S. dollar index. It seems like everybody and their mama is on the dollar bull side of the trade right now, and it's a very crowded trade. It's very extended, and historically, anytime it gets this extended, it will start to have a turnaround and head lower. And when the dollar does head lower, it can do that rather quickly. And so that alone would give a huge boost to both gold and silver. Also, there's still a ton of turmoil around the world and a lot of uncertainty. A lot of currencies still getting undermined with interest rates being lowered, some places even going into negative interest rates, all kinds of things happening there. So all those things that are bad for paper currencies all over the world can be long-term good for gold as well.
Yeah. Well, you also see in terms of like the dollar bull trade, the Fed talks about raising interest rates, and the timeline was June. Do you think it's possible for the Fed to raise interest rates without crashing the stock and bond market?
No, well, I don't think that they're going to be able to raise interest rates as quickly as they thought, and I think that's why they had to go in and talk about patience, and in other words, code word for we're going to have to delay this thing out a little further. And you could tell from some of the rhetoric that the rise of the dollar is one of their big concerns because it keeps inflation lower than they want, and also it could potentially wreak havoc around the world as our dollar gets overly strong and making certain currencies overly weak, and it just ruffles the feathers of some countries around the world. So I think that the dollar will have to come down before they're really able to start raising interest rates. So I think that they're going to start to do what they need to get the dollar lower so that they can raise interest rates. But it's got to go materially lower, but the good thing about the dollar is typically once it does start lower, it heads lower fairly quickly. So if they can get it low enough, then they could possibly do some, rate rises. Even if they do some rate rises, I don't see interest rates going up materially, meaning they may do a quarter point here and wait a while and then a quarter point there and, over a long period of time move up 0.5% or something like that. But I don't think, I don't see interest rates being several points higher, a year or two from now or anything like that, nothing drastic.
Yeah, I don't see them really doing anything material, like you say, at all. Like, maybe they do a token raise to restore confidence, but I don't know. To me, it just seems like they're trapped. And if you look at gold, too, you see China and India, and you see a lot of demand. And in terms of the economy, I don't know about you, but when I followed the data, there was a quote-unquote good job numbers. And the only reason I say good is I mean the market and sentiment valued it as good, not that it's actually good. If you look at a lot of quality of jobs and participation rate, but if you look at the sub data, like the existing home sales yesterday, the sub data hasn't been looking good at all for the U.S.
Yeah, absolutely. And even, in the rest of the world, there's a lot of the global economies that are slowing down. And so that's bad for the globe. It's bad for a lot of currencies, and thus it's going to end up being good for gold and silver as well.
Yeah. And one thing I want to get into now, you wrote an article about an alternative to penny stocks. And actually, this is an interesting philosophy or strategy I wanted to get out to my audience, and it's about buying large cap, small, low price stocks. Would you be willing to just briefly summarize what that is?
Yeah, basically, a lot of people love cheap price stocks, and they like it because of their ability to go up. Hey, if this stock goes from $1 to $2, I've doubled my money, kind of a thought. But the problem is a lot of companies got to $1 per share because they should be at $1 per share, and when you look at their fundamental balance sheets, I mean, they're just horrible. They're bleeding money. They're increasing their debts. They're in horrible condition, and many of those are on their way to zero. Also, many institutions are basically barred from investing in them because they're so cheaply priced. But if there's any cheap stocks that institutions and things like that can get into, it's larger companies that have been around a long time that are temporarily beaten down, that could have sizable turnarounds. And like an example is AMD is one. Smith & Wesson not too long ago was another one. Nokia was another one. Again, they're companies that have been beaten down for whatever reason, and sometimes it's industry related, sometimes it's directly because of something that's happening and going on with the company itself. But when you get really large companies, and especially if you can look at their balance sheet and you can see that they've got usually plenty of cash at that given moment, then it becomes a lot better tradable instrument than this cheap price stock that is a small company that a lot of institutions can't get into and haven't gotten into and wouldn't get into it even if they could, and that's likely on its way to zero. So it's just a different way of doing it. So I screen stocks differently in that regard, and you can come up with stocks that are have a lot better favorable chance of rising in the future, and they don't have to be your average penny stock that's your no name, nobody's hardly heard of, and it's $1 going to zero kind of a stock.
Yeah, that when I read that, I was thinking that actually is a pretty good strategy, especially if you diversify within a couple of stocks.
Yep, if you gather up about 5 or 10 names, and invest, I mean, you still don't have a ton of capital allocated because, again, you're not dealing with $50 stocks. You may be dealing with $5 stocks or $9 stocks, but you can acquire quite a few more shares of it and diversify. And, pick 5 or 10 stocks like that and go with it. And, sure, there's always a possibility that, 1 or 2 of them could fail. But for the 3 to 7 others that you have that soar, they can more than make up for that. And the chances of even, if you screen right, I mean, the chances of any of them failing really aren't that great. But you just know anytime you are investing that way, of course, it is more speculative, but that's also why you can potentially, gain more than you would on your average, S&P 500 stock, for instance.
And my last question is, you wrote this was a little bit of an old topic, but when I just recently read this, I thought this was a great point, was your high frequency trading article, The Other Side of the Coin. Would you be willing just to? Yeah,
there was a lot of stink about high frequency trading and how the market's rigged, and how these guys are electronically jumping in front of your order, and all this kind of stuff, and not that any of that is not true, but it leads the average Joe out there, the average person like me or you, to to think, if we're just watching all this on TV, to think that, well, the market is rigged, so therefore I shouldn't invest in it. But notice that Warren Buffett didn't pull all of his money, because there's some electronic guys doing some stuff on the very short end. Now, he's still an investor, and there's still a ton of money to be made for true investors. All that competition is down on the ultra short end, where they're measuring things in seconds and microseconds and nanoseconds and all that kind of craziness. But true investors, it's never been a better time to invest, because a lot of the biggest competition is down on the short end of the stick and not the long investable end of the stick. So, you buy a great company and hold on to it for years, and you're still going to end up with a great return, and likely a market-beating return if you buy it right. And so it kind of is misleading in a way, because it acts like you can't make any headway, or you can't really invest successfully because these guys exist or because they do what they do. But that's simply not true at all. And true investors, it doesn't deter them a bit at all. And also, costs are now lower than they've ever been. So the spreads between buy and sell prices are narrower now than they were 10 years ago, 20 years ago. The commission costs are lower now than they were over those same periods as well. So the ability for you to get in the profit and get to making money is, that bar is lower now and easier to overcome now than it was in the last decade or two.
That's a great point. So lastly, it was nice having you on. If people wanted to find out more about you, how can they do so?
Yeah, they can go to ultimatewealthreport.com and find out more about what I do in my paid subscription newsletters. And they can also go to moneynews.com and click on the Insiders tab to review a lot of those articles that you and I discussed today.
All right. Thank you for coming on. I enjoy speaking with you. We'll have you back on in the future.
Okay. Thanks so much. I appreciate it.